Hi, Patrick, and everyone at Valuetainment. I hope you see this video. I don't know if you will or not, but I decided to give it a shot. Actually want to just give you information. If you ever wanted to have me on the show, fine. But I see you guys talking a lot about interest rates in real estate and the stock market, and this is what I do for a living. And I think I have a unique perspective and maybe some things you haven't seen in the past. So I just want to show you, I'll do a little quick start on who I am. This won't take more than a minute. So my name is David Skarica. I am from Canada. I'm kind of like, I guess, first generation Canadian. I live in the Bahamas now. I've lived in the Bahamas for almost 20 years. But anyhow, last name is Skarica. That's Yugoslavian. My grandfather was from Bosnia. So my grandparents were all immigrants after the war, etc. So this was the first book I wrote, and it actually came out in October of 1998, not January. That was incorrect. And whatever. So anyhow, this was talking about how the stock market was in a bubble and you wanted to buy gold and commodities and real tangible assets. And over the next 10 years, we had the NASDAQ bust, and the stock market did terribly, and commodities boomed, gold and silver went way higher, etc. I wrote this book and I was only 21 years old when I got published. I wrote it when I was like 19, 20 years old. Actually, was the youngest person in history to get the securities course license in Canada. The CSC, it's called Canadian Securities Course. I was 18 years old when I got it. So I was born in 1977, by the way. So these are some of my other books. This was The Great Super Cycle, which was published through Wiley. I think this sold nearly 40 or 50,000 copies. I got the deal through Newsmax. I still work with Newsmax. And this is my new book that's coming out here. This is called Mega Returns. I'm a big believer of buying beaten up cheap assets. That's what John Templeton is kind of my mentor used to do. So this is looking like it's going to come out early next year. I guess it got pushed back. It's initially going to be published in December, whatever. Now it's January of next year. So I just did the last edit of that book. So it's through Newsmax, which is the largest, one of the largest conservative websites, probably the fastest growing news website in the world. So this is it's something I wrote in the early 2010s, where I talked about all this money they were printing. The zero rates was going to cause, inflation, bonds to crash, and bonds, of course, the yields are way up, bonds are way down, and inflation started to occur. It took longer than I expected. I didn't expect it. I wrote this probably like 2010. I didn't expect it to take 14 years, but it did occur. So this was, I was in the Globe and Mail stock picking contest back in 2003 when I was starting out. I was young, and they had 10 people that were professors, analysts, etc. And I finished second in the contest. So, and the stock I picked went up 95%, and etc. So just again, a little more about who I am. So I write for Financial Intelligence Report. This is a publication through Newsmax. I've done this for 15 years. So, etc. So this is where the presentation really starts. I just want to tell you, I want to be very quick talking about myself, etc. So the presentation really starts here. So the issue right now, because I've seen you guys talk about, I've seen Patrick say, will interest rates ever go down? And here's the issue we're going to have. Interest rates are not going to go down significantly ever again. Those days of zero rates are over with. And this is the biggest reason why. The U.S. national debt is $35 trillion. And the thing that drove me nuts at that Republican convention, okay, we're all happy that obviously Mr. Trump survived his ordeal. And, I lived in America. I would probably be voting for Trump over the Democrats as well. But the issue is this. I didn't see anybody talking about this at this convention. And this is actually the biggest risk to your freedom, prosperity, everything. It's not all these little culture wars and all this sort of thing. It's this. Country is $35 trillion in debt. The budget deficit this year is going to be north of $2 trillion, which is over 7% of GDP, which is unheard of during an economic expansion cycle. So it's 122% of GDP. Now, here's the deal. The Fed owns about 15 to 20% of this debt. So the amount the public owns is really like 100%. But again, outside of World War II, when we ran up the debt to fight the war and fight the Nazis, we have never seen the debt this high. And here is another issue. You can see, again, the federal government's spending about $7 trillion. Well, if you do the quick math here, 3.2 4.1 plus, it's about 5 trillion that's on interest, defense, Social Security, Medicaid, Medicare. So the whole deficit is basically the rest of the budget. So you would have to cut the rest of the budget to zero to balance the budget right now. That means whatever, the Ministry of Education, Homeland Security, blah, 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 blah. Outside of those, the basics, which we consider defense, Social Security, Medicaid, Medicare, and interest, you would have to cut the budget, the rest, all those other programs, all the other government agencies to zero to balance the budget. And the problem with that is that when you have a recession, spending goes up because outlays go up. You have to spend more. You have to, welfare payments go up, unemployment insurance goes up, et cetera, et cetera. Revenues go down. Why? Because less people are working, blah, blah, blah. So at some point, you're paying taxes. At some point, when taxes go down, or tax revenues go down, we're probably going to have a $3 or $4 trillion deficit. And before the financial crisis, the debt was like 60% of GDP. Now it's twice that. At some point, the government cannot afford this anymore. And one reason that rates are higher is the market is asking the government, we need more return on our money because you're not the gold standard anymore. America is, okay, it's the biggest country in the world in terms of the economy, but, and, it's still the reserve currency of the world, but, the debt is so high. This is third world banana republic levels right now. So the market is essentially telling you, you need this higher interest rates because you're not as a safe investment as you would be. And then you can combine all this political kind of infighting that's going on for years as well. That obviously makes another appearance of like instability. So then this again shows the debt to GDP. And you can see in 1980, we were at 30%. And then we were just around 60% before the financial crisis. And then you can see that basically exploded afterwards and then exploded during COVID as tax receipts collapsed and outlays exploded as they did the bailouts over COVID. So this again shows the debt to GDP. And you can see here, it did peak a few years ago because, it came down after those COVID measures, but it's back on the way up. And the CBO estimates by 2050, this is going to be 160, 170% of GDP, that's completely unsustainable. Like that's, again, third world banana republic type levels. So this is ABC. And what I try to show here, this is really not political. All the parties are guilty of doing this. So this goes back to 1977. And we can see under Jimmy Carter, it started to go higher. And then under Reagan, it exploded more higher because Reagan cut taxes, but he didn't cut spending, right? Under Bill Clinton, because Clinton had a huge boom in the economy and military spending could be slowed down because Russia and Soviet Union was bankrupt. It kind of went up slower. Then Bush had his wars and unfunded tax cuts. And then Barack Obama had the advantage of having zero interest rates. So he kept spending as well because it would cost nothing to borrow money. And then Trump kept spending, and it was going way up even before COVID. That's the big jump during COVID. And then, of course, Biden recently. So all the presidents are under all the administrations, under both parties, is guilty of this. Okay. So I just want to show this. And this is why I don't think it matters who wins the election. And at some point, you go too far with that. After World War II, the UK was bankrupt because of the empire, the wars, etc. Spanish, French, Netherlands, all of these old empires always overextend themselves. All the superpowers do this, and then they end up going bankrupt. It's just like a natural evolution. Ray Dalio, the biggest hedge fund manager in the world, has an excellent videos on this. If you look them up on the internet, where he talks about the rise and fall of empires. And this is what ended empires. It doesn't matter if it's Rome 2,000 years ago, or it's the United States now, or the UK 80 years ago. It's always too much debt, living beyond your means, et cetera, et cetera. So this is the inflation spikes. So when you're going to print money and spend money and you have more debt, you're going to have higher inflation. So this showed the last 2 decades that we really had high inflation. So the first one was the 1940s. And what we can see in the 1940s was that there were 3 separate inflation spikes. There was the early 40s during the war, where inflation went to double digits. The late 40s, right after the war finished. And then again, there was another little inflation boom in the early 50s as well. So you can see 2 of the spikes were into double digits. and then the early 50s went out of the double digits, and then we went to the post-war boom, and we had stable prices until the 1970s. But why did we have this? We had this because you had to print money, to pay for the war. You print money and spend money to pay for the war. The deficits were huge, and that led to ultimately to price increases. So this is the 70s here, and you can see another three. In 1970, you had over 6%. And then, in the mid 70s, you had it to 12%. And in the early 80s, you had it to 13%. So what's interesting about these charts is we see in each case in the 1940s and the 1970s, we can see that there was three spikes in inflation. And again, both cases, happened in the 60s and 70s that you had President Johnson expanded the welfare state. You had the war in Vietnam. You had all these expenditures, and then the U.S. had to print money again to pay for it. So you had higher inflation. After you can see the 50s and 60s and these stable prices, it started to move higher. And remember, the way they report inflation now is they underreport it. Like this 6% back in 1970 is like 8 to 10% now. So I think that's what we just saw in the first spike in inflation. And I think we're in this kind of lull right now where we're going back to 3-4% right now. And then we're going to see another spike going forward. And it doesn't matter who's president, because if Trump does decide to have a dovish Fed, well, cutting rates to 2-3% and printing money with the debt levels where they are now is going to cause an even bigger spike in inflation. So, and here's another thing that's interesting. So inflation leads to interest rates. Well, when inflation goes higher, you need higher interest rates to kind of squash inflation, or because investors want more return on their money because their money is losing value because of inflation. So you need a real return. So the first inflation and spike was actually in the 19-teens after World War I, because again, they printed all this money to pay for World War I, and inflation went high. And then you can see that interest rates went to almost 7%. But then for almost 30 years into the late 40s, interest rates went from 7% to 1%. And then you can see as they again printed money and we had these wars, we had to pay for it, et cetera, et cetera. And what was interesting, they kept rates low during the war. But why? They needed to keep rates low to pay for the war. And people didn't care about buying bonds and losing money on them during the war. And the reason being was, it's a patriotic thing. We're beating the Nazis. So if I got to buy bonds at 1 or 2% and inflation is 10%, I don't really care about this. I'm doing it to fund the war effort. So that was a bit of an anomaly. But you can see in the 60s, 70s, to kill inflation off, they had to raise rates to 14% to get rid of the double-digit inflation. And then we've been in this nearly 40-year trend downwards. And we'll show you the update of this now. And I'm going to show you the short-term interest rates till now. So and also these rate cycles tend to be very, very long in span. This one was nearly 30 years to the downside. This one was about 32 years to the upside. And this one was nearly 40 years to the downside. So this chart again shows it. Now, it doesn't mean you're going to go up in a straight line. I do believe that the Federal Reserve actually will cut rates shortly, but I'm going to show you something very important about this graphic that I'm showing you here, right? Is that we go look at the interest rates going up from the 50s and 60s. Yeah, they cut in the late 50s, they cut in the early 60s, they cut in 70, they cut in 74, 75, blah, blah, blah. But the long-term trend was higher. And then just like the long-term trend was lower, from here until like 2022, early 80s, 40 years. Well, there were still times like 87, 88, or the early 90s, or 2003 to 2007, where they raised rates. So nothing goes in a straight line. So right now, what's really interesting is you can see this trend of lower highs, lower highs, lower highs, lower highs in interest rates. Okay. So here we can see starting in 2022, this is the first higher high in over 40 years. And I think this is a change. So yeah, can they cut rates back to 3? Sure. Again, go look what happened in the 50s. There were rate cuts here. There were rate cuts here, right? But I think our interest rates are now going to see a series, again, of kind of like the 50s to the 70s. We're going to see higher highs and higher lows. So yeah, rates could go down to 3% here in the short term, but ultimately we're going to go higher. And the problem we have now is debt to GDP was 30% back here. Now you can say in a couple of years, it's going to be 130%. So you can't afford these higher interest rate payments because that's too much interest on the debt for the government to pay and will bankrupt the government. So if they do keep rates artificially low, like they did in the 40s during World War II, it means that we are going to see higher and higher inflation. And this is just economics. This has nothing to do with Trump, Biden, Democrats, Republicans. Both parties have caused this by their spending and not controlling the deficit. So this here, I wanted to show you. So this is the average, because I've seen, Patrick, you talk about interest rates, and they gotta go lower and blah blah blah, and housing. Well, this is basically mortgage rates going back, to the early 70s. And what we can see here, there's a spike during inflation, then this long-term trend down. But if you were to draw a median level, it'd probably be between 7.5% and 10%. That's about the mean average interest rate of the past 50 plus years. So even where we are today, 6.86%, that's the last reading on this chart on a fixed rate mortgage, you're still below the median. So that's the problem. Everyone thinks that this, since 2010, was the normal. No. These 2.5% to 5% interest rates were completely abnormal. They were historical lows. So at the very least, you've got to stay in the 6-7% range, and people have to stop thinking that this was the normal. Now, if there's some kind of gigantic deflationary crash in the economy, yeah, they could go back to 2-3% in that scenario. But the issue with that is, in a big crash like that, people are going to be thrown out of work. They're not going to have jobs. They won't even be able to afford a mortgage or take advantage of those rates. But I just wanted to show you, this is the abnormal, the last 10 years, and definitely during COVID, from 2000, here we're right here, from April 2000, 3.33% to like late 2021, September 2021, 2.88%. Like, that's what the abnormal is. So this also brings us to the stock market, because I know a lot of people think that if Trump wins, the stock market's going to boom. It's great for business, blah, blah, blah. But look, sometimes Republican administrations, even though Republicans are viewed as more pro-business, the 2000s under Bush, Hubert Hoover was president during the Great Crash of 1929. That is not necessarily the case. The stock market did great over Obama. And Obama was not pro-business, because why? They could print trillions of dollars and leave rates at zero after the financial crisis. So this is a very simple indicator. It's Warren Buffett's favorite indicator. It's ratio of market cap to US GDP. So it basically shows you the size of the stock market, the total market cap of all the stocks in the stock market, divided by the total size of the US GDP. So essentially, what this shows is that we're at, right now, at this moment, near 200%. Now, the only time we hit that in the past was when the COVID in the stock market blew off in 2021, and again went to 200%. What happened then? The market dropped 25%, the S&P, in 2022. NASDAQ went down 30%. The only other time we had been this high in history was, we're going to get an all-time chart here, was back in the dot-com bubble, when the stock market cap, the GDP, went to just over 140%, okay? And usually, historically, 100% was never even heard of. That's about what happened during 1929. It happened again in 2007, and stocks crashed. And of course, it happened in the late 90s, and then stocks crashed. So this last 10 years cycle has been unheard of, where you're over 100% of GDP and near 200% of GDP, and especially over 150% to 200%. And stocks are this overvalued. So this has never been heard of. So I would say that even if Trump wins, there's very, very, very limited upside for stocks at the moment. And then there's all these other issues underlying in the market, where the Magnificent Seven, the Microsoft, Apple, NVIDIA, Tesla, etc. These are the companies that have mostly driven the market, and it's very narrow. It's the most narrow it's ever been. The top 5 companies in terms of market cap of the S&P make up the most of the S&P, most in history. So you can see here, this shows you too that when the ratio is under 83%, that's where we got, back in 2009. You can see we actually got close to 50% then. And then stocks are undervalued. When it's over 150%, we're significantly overvalued. So right now we're the second most overvalued, and we actually got back to those 2020 levels. Sorry, yeah, 2021 levels. But then, of course, the market sold off. So I'm just telling you right now, just to summarize what I've told you here in this presentation, we have debt near all-time levels. We have, in terms of the government, we have interest rates probably starting a long-term cycle higher, even though in the short term they may go lower because of the amount of debt the country has taken on. So we have this interest rate cycle going higher, we have this debt cycle going higher, and we have equity valuations near all-time highs. And we're in an inflationary cycle now. We've seen the first leg up, kind of like we saw in the early 70s, kind of like we saw in the early 40s. And what we can see is there's usually 3 legs higher in an inflation cycle. So we probably have 2 legs to go. And you think about it, Social Security, Medicaid, Medicare, the boomers are all retiring, okay? How are they going to pay for this? They're not going to, there's three methods. Either get a default on the debt, which they're not going to do, especially because of the reserve currency. You slash spending and you raise taxes to increase revenue to be able to fund some of these things. They're not going to do that. The politicians can't do that. Or number 3, you just print your way out of it and you cause inflation, which is probably the most likely scenario. So I hope you enjoyed this. You'll have my contact in the email. I would love to do your show if you ever want me on. I know I'm not some big time name. You have a huge show, but I really enjoy watching it every day while I work. And but I'll give you a link to my page on YouTube. I think you'll see from my videos, I know what I'm talking about. Like I said, I did my Great Super Cycle book, probably sold close to 50,000 copies. So I do know a little bit what I'm talking about. And yeah, like I said, I do enjoy your show, and I hope you enjoyed this presentation. I did it just for you guys. I don't know if anyone will ever see it, but yeah, I know you're doing Zoom shows right now. Like I'm going back to Canada in August. I would be more than happy to stop in Florida on my way back up to do your show, or if you wanted to have me on Zoom, I'd be happy to do that as well. So man, have a great one. And yeah, I hope you enjoyed this, because I put a lot of work into it. I think you can see.